Community wealth building is an economic development strategy that focuses on creating and retaining wealth within local communities, rather than letting it flow out to external corporations or investors. In simple words, it is about making sure that the money generated in a community stays in that community, supporting local people, businesses, and institutions. The idea grew out of dissatisfaction with traditional economic development models, which often rely on attracting big outside companies with tax breaks or subsidies. While those investments may create jobs, much of the profit usually leaves the local area, going to shareholders or corporate headquarters elsewhere. Community wealth building instead emphasizes ownership, inclusion, and long-term resilience. It became more popular in the late 20th and early 21st centuries, especially in response to rising inequality and economic insecurity. At its core, community wealth building has several key principles. First, local ownership of assets. This includes cooperatives, employee-owned businesses, and community land trusts, where the wealth generated directly benefits the people who live and work there. Second, anchor institutions. Large place-based organizations like hospitals, universities, or city governments can direct their purchasing, hiring, and investment power toward local suppliers and residents, strengthening the local economy. Third, inclusive finance. Community banks, credit unions, and public funds are used to support local businesses and social enterprises, instead of relying solely on global financial institutions. Fourth, fair employment and democratic participation, meaning workers and residents have a stronger voice in decision-making and benefit more directly from local prosperity. An example makes this clearer. In Cleveland, Ohio, the Cleveland model created a network of worker-owned cooperatives that supply goods and services to local hospitals and universities. These cooperatives keep profits circulating within the community, provide stable jobs, and empower workers. Similarly, in Preston, England, the City Council adopted a community wealth building strategy by redirecting millions of pounds of procurement spending to local businesses and cooperatives, revitalizing the local economy. Economically, community wealth building challenges the trickle-down model. Instead of hoping that outside investment will eventually benefit local people, it builds wealth from the ground up, making communities less dependent on external corporations. It also tends to make economies more resilient, since locally rooted enterprises are less likely to relocate in search of cheaper labor. There are also challenges. Building community wealth often requires strong local leadership, supportive policies, and patient investment. It may be difficult to scale, since not all industries can easily be localized. Critics argue that while community wealth building is valuable for social justice, it may not always maximize efficiency or growth compared to traditional models. A curiosity is that some governments now view community wealth building as part of a just transition toward greener economies. By investing in local renewable energy cooperatives or community-owned housing, communities can not only keep wealth local but also tackle climate change and inequality at the same time. To summarize, community wealth building is an approach to economic development that prioritizes local ownership, inclusive finance, and long-term prosperity for residents. It contrasts with traditional models by rooting wealth in communities rather than letting it leak out, making economies fairer and more resilient. Up above, I left you more videos so you can keep learning law. Remember to leave us a like and subscribe.